Hey guys, welcome back to the channel. Today we want to discuss what are some good ways to invest your short-term emergency cash. So let's get right into it. Treasury bills, or T-bills for short, are a type of short-term bond issued by the United States government. Other types of bonds have maturities of over 1 year. Perhaps they range from 1, 10, 20 years, and so on. So you can even loan your money to the US for 30 years. Treasury bills, however, always mature in 1 year or less. You can buy them for 1 month, 3 month, 6 month, and 1 year, and they're considered the safest investment of all. They are called the risk-free investment. So what does that mean, risk-free investment? What that means is that the United States government is considered the safest investment that you can make. It's considered so safe that even rivals of the United States, like China and Russia, invest their emergency money into United States Treasury bills. You can buy the stock of Walmart or Apple, but who can guarantee that people will still be shopping at Walmart or buying iPhones in 20 years from now? I know Apple's a very strong company right now, but what if someone invents technology for, talking to each other through our thoughts, right? The point is that maybe stocks of companies can go out of business. Companies that issue bonds can go bankrupt. But the common wisdom in the investment world is that the United States will still be around to pay you back your interest. And it kind of makes sense. If the United States government needs extra cash, what can it do? Well, it can make me and you pay more taxes. Or it can literally print more money through the Federal Reserve and the Treasury. They can literally create money out of thin air. Can you or I do that? Can Apple do that? We can't. Many have tried, but have gone to jail for a crime called counterfeiting or making fake money. Treasury bills don't pay interest every 6 months like bonds do. Instead, they're sold at what's called a discount to par value. Let's say current interest rates for T-bills are at 5%. You would get a 5% discount on the price of the T-bill. So a T-bill with a par value of $1,000, after a 5% discount, you would buy it for $950. As we can see the calculation here, we multiply it by 0.95, which means you'd only be paying 95% of the price, which means that you'd be getting a 5% discount on the price. And that means you'd buy that particular T-bill for $950. So you buy the T-bill for $950, you save $50, that $50 stays in your brokerage account. And when the T-bill matures, you get back $1,000. Now you combine that $1,000 that you get back from the T-bill when it matures, combine it with the $50 that you saved from buying the T-bill at a 5% discount, and you have a total of $1,050. And if you do the math, that means that you made 5% on your T-bill. We can always double check that. Let's do 1,000 times 1.05, which is 5%. And that equals 1,050. So some people get that notion wrong of they don't want to buy treasury bills because they're not getting paid interest every 6 months. You actually make your money up front when you buy the T-bill through a discount. So instead of the T-bill maturing in 6 months or in a year and giving you $50, you save $50 on the purchase. So you get to keep that $50 of interest up front. Now, what you do with that $50 is up to you. You can invest it in something else, or you can, depending on your broker, they can put that $50 into the T-bill as well. That way you get a little bit more interest out of your money. So work with your broker on that one if you have questions. All right, so who invests in treasury bills? Generally, people who have a short-term need for their money will invest in T-bills in order to generate some extra income. If you had $100,000 saved up to buy a house in 1 year, you could buy a T-bill in your brokerage account or directly from the government at treasurydirect.gov. If rates were 5%, you could earn $5,000 on your investment of $100,000 rather than it just sitting in your bank account for 1 year. Remember that T-bills sell at a discount. So in this example, you would borrow only $95,000 to the government, and they would pay you back $100,000 a year later. You could spend that $5,000 left over, or you could invest it in something else. It's up to you. But just remember that you get your discount up front. So how do you make money on T-bills? Well, we already said that you buy Treasury bills for a discount. And when they mature, you get the full amount back. Similar to a bond, except that Treasury bills don't pay you interest every 6 months. They sell for a discount equivalent to what the interest rate is. Let's do another quick example. Let's say we have a 6-month Treasury bill and it has a par value of $1,000 and it sells for a 5.5% discount. How much would you have to pay for it? Let's do the math here. 1,000 times 0.945. That's the equivalent of a 5.5% discount. We get $945. So you pay $945, and in 6 months you receive $1,000. But hold on one second. That 5.5% discount, this T-bill matures in 6 months. So if you had left it for a full year, you would get a complete 5.5%. But since it's only 6 months, half of the year, you're actually going to get half of the 5.5%. So you would actually only earn 2.75% on your money. You can that when it matures in 6 months, you can go ahead and buy another 6-month Treasury bill, and you can earn another 2.75. And in the full year, you will have earned your 5.5% interest. So a lot of investors get that twisted as well, is that they think that they're going to earn the full 5.5% in 6 months. That's not the case. Those rates are annualized rates. So if you only hold it for 3 months, then you're going to split that 5.5% into fourths, right? 3 months is only a fourth of the year. So make sure you do the math. Tell your broker as well to help you with that calculation if you have any kind of problem with that. Again, the difference between a T-bill and other types of bonds is that T-bills don't pay you interest. You just buy it for a discount. You save the money when you buy the T-bill. Let's think of this in another way. So when you go and buy a car, sometimes they can give you a discount on the price of the car, or they can give you money back, which they call a rebate. If they discount $100 from the car, then you save that amount of money. But if they mail you a check for $100, then this, in effect, you're still getting the same deal. It's the same thing with Treasury bills and regular bonds. And this helps the government because they don't have to worry about paying interest twice a year. They just worry about paying the principal back at the end. Let's go over the pros and the cons of T-bills. One of the pros is that you have a predictable source of income. So the United States government has never not paid back its bondholders. So for now, if everything holds, you can rest assured that you'll get your interest and your principal back from the United States government. Another pro is that you are growing and making money on your money. So you're getting some kind of return on your money. So that's good. It's a nice, safe return. Another pro is that you are investing in what's considered the safest investment in the world. So the United States Treasury bill, don't get it confused. I didn't say all the other bonds. I'm saying the United States Treasury bill, the one that matures in 1 year or less, is considered the risk-free investment. Now, some of the cons here is that, your money is not going to grow by much. Sometimes when, interest on T-bills is at 2%, 3%, inflation can be going at about 5%, 6%. During periods like that, your money's not keeping up with inflation. You're actually losing purchasing power. So by investing in treasury bills long term, you'd actually be losing money in the long term. But we're not talking about long term, right? I want to get it clear that I'm talking about treasury bills for short term money, money that you need in a year or less, right? Maybe you're going to go and buy a house in a year. Maybe you're going to go buy a car in 6 months, things like that. So treasury bills are suitable for short term investments to just so your cash isn't sitting in the bank account making 0.003%. That's what T-bills are better for. So you won't outpace inflation, and there's also opportunity risk. So by putting your money in treasury bills for long periods of time, or putting extra money that you don't need anytime soon in treasury bills, you're not taking opportunities with other investments. And I'll just refer to stocks, right? Because that's the best long-term growth vehicle, in my opinion. You're not investing in stocks. Instead, you have your money stashed away into treasury bills. And so you're missing out that long-term growth of 10% or more that stocks can bring. There's a couple of quotes that I like to think of when fear and doubt starts to creep in. One of them being, scared money don't make money, right? Scared money don't make money. So if you have scared money that you're just going to put in CDs or T-bills when you don't need that money for 10 years or longer, you're not going to make money. And then also there's another saying I like, is that it goes, money lives on the other side of fear. Money lives on the other side of fear. So, get over that fear of investing and just do it, right? Now, don't put all your money into just one stock or anything like that. I advocate a diversified portfolio, right? That includes stocks, bonds, real estate, maybe a little bit of crypto, treasury bills, money markets, cash, all that stuff, right? You don't want to put all your eggs in one basket. All right, so let's wrap this up here. How risky are T-bills? How risky are they really? So as far as the value of your money dropping, T-bills are not very risky. Your value can drop by a little bit if interest rates in the economy move up fast enough, but it's not going to be a major drop like with investing in stocks or bonds. Now, and I say that your value can drop a little bit, but if you're holding the T-bill until it matures in 3 months, 6 months, or a year, then you're going to get the full principal back anyway. Because remember what we said, the United States has never not paid you back. So you can count on that money to come back to you. If you want to sell it before it matures, then, if interest rates went up or other things happen in the economy, the price that you sell your T-bill for could go down a little bit. But it doesn't go down by a whole lot. So, like I said, there's a reason that treasury bills are considered the risk-free investment. So I have the rankings here. We have, at the top, we have our riskiest asset class so far that we've discussed on this channel, which is stocks. And then bonds are a little bit safer than stocks. And then treasury bills by the government are even safer than loaning your money to other governments or municipalities or corporations, right? The U.S. government is the biggest entity, so they're going to be safer than that. And then if you absolutely don't want to put any of your money at risk at all, it's not going to go up in value, but it's definitely not going to go down in value, well, then you just hold cash in a shoebox or under your mattress, however you prefer to hold cash, right? Maybe it doesn't have to be like that. It's an extreme example. Maybe you just have it in your checking account, which that's fine. It's not going to go up and down as far as cash is concerned. Now, is there a scenario where the U.S. could not pay back its treasury bills? The only thing I can think of is maybe if they lost a war to Russia or China, but those scenarios are of war against China, Russia. They're not as likely as the news and media would have you think. So wouldn't really worry about that. And like I said before, even Russia and China are putting their emergency money into United States Treasury bills. Not because they have some kind of sense of obligation of we have to help the US out. They just need a good return for their cash. And so by putting it into United States Treasury bills, they're going to make some money with their cash that they have sitting around, and they're going to get a pretty decent rate. And like I said, the United States has never not paid back, so they know they're going to get their interest and principal back. So that was T-bills. Hopefully you guys learned a little bit about that, Treasury bills, and hopefully that helps you. Maybe that's another option for you with your short-term emergency money cash, or just kind of cash you have on the side you don't want to take any risk with. Treasury bills are a good option for that. And like I said, you can buy them through either your broker. So talk to your broker and talk about Treasury bills. You can buy them you can buy them straight from the United States government, treasurydirect.gov. The United States government sells T-bills on their website. In the next video, we're going to talk about money market funds and money market accounts. Another way that you can get some kind of return on your cash without putting in a lot of risk. So join me in that video.